Monthly readings of inflation from around the world continue to dominate the financial headlines and also set the tone in financial markets during the third quarter of the year. The introduction of the energy price guarantee will prevent inflation in the UK rising to the alarming levels which were being forecasted by Citibank and Goldman Sachs in August. But the weakness of sterling increases the costs of everything that has to be imported. As before, the question is not when and where the peaks in inflation will be. We are confident that it'll come down, but where it settles. The risk of a wage price inflation spiral remains. Unsurprisingly, central banks have stepped up their fight against inflation and become more aggressive in raising interest rates. Just 3 months ago, it was widely thought that interest rates in the UK would reach 2.75% in 2023. We're now seeing forecasts of 5% or even higher. Rising mortgage rates and other increases in the cost of living are taking their toll on consumer spending, which is a big component of economic growth. The consensus for now is that economies will muddle through and that any recessions will be shallow and short-lived. This may prove to be too complacent. At the end of the second quarter, investors in bond markets probably thought it couldn't get any worse. They were wrong. The rise in bond yields from the absurdly low levels caused by years of distortion from negligible interest rates and continuous bond buying by central banks has been brutal in both speed and scale. Investments in government bonds are safe, but only in the sense that investors will get their capital back when a bond matures. To make matters worse, the UK gilt market was sent into a tailspin at the end of September after the new Chancellor announced a raft of tax cuts which appear to be unfunded and may need to be paid for by yet more government borrowing. Yields on 10-year gilts soared from 3.5% to 4.5% in just 5 days, threatening the solvency of many defined benefit pension funds and forcing the Bank of England to step in to stabilise the gilt market. Year-to-date losses for investors in the gilt market as a whole ballooned from 14% at the end of June to 25% at the end of September. After years of offering only miserly returns, yields have risen to levels at which bonds now have some attractions and can perhaps once again be considered as genuine alternatives to equities. For example, yields on 10-year gilts have risen from 1% at the beginning of the year to more than 4% now. It seems ridiculous that just 2 years ago, investors in 10-year gilts were receiving a return of just 0.1% per annum to lend to the UK government for 10 years. However, even though yields have risen substantially, it doesn't mean they can't go higher still. That possibility will remain until a downward trend in inflation is clearly established and there is certainty that interest rates have peaked. In a word, yes, global stock markets seesawed violently in the latest 3-month period, but finished with losses for the third quarter in a row. Year to date, global stock market indices have fallen by more than 20% in local currency terms. Although we certainly understand the anguish being suffered by investors, it should be remembered that equities are long-term investments. Volatility and periodic losses go hand in hand with the superior returns that equities have provided over time. Despite the painful losses this year, global equities have still provided a return of almost 10% per annum, including dividends, over the last 10 years. And this is before the weakness of the pound is being taken into account. The figure for the UK stock market, a notable laggard, is 6% per annum. Over the same period, consumer price inflation in the UK has averaged 2.5% per annum, and sterling cash deposits have provided a return of just 0.5% per annum. The UK and Japanese markets once again proved to be the most resilient in the third quarter, the UK continuing to benefit from its heavy weighting in large multinational companies whose profits have been boosted by the weakness of the pound, and also its dearth of highly valued growth stocks, which have led the retreat of the US stock market. Within the UK market, however, we continue to see big variation between the performance of the biggest companies, down just 3% year to date, and smaller companies, down almost 25% year to date. The fortunes of smaller companies are, of course, generally more aligned to the health of the domestic UK economy. Declines in stock markets so far this year can mainly be attributed to falling valuations as bond yields have soared. Looking ahead, we think that corporate profits will become the main driver of share prices. We therefore believe that investors will become more and more discerning and that stock selection will become increasingly important. No company can insulate itself from higher wages, higher energy prices, and higher interest costs. However, we expect the profits of companies with strong balance sheets and dominant market positions to prove the most resilient in any economic downturn. In the portfolios we manage, which use actively managed funds, we are therefore emphasising exposure to high-quality companies which have these characteristics.